She said, don't you cry, your heart won't lie, but the clock is ticking still. Velvet sky, I gotta make a difference.
Yo, what's up, stream? Let's go. And chat. Rally, rally, rally. Hit that like button bottom right of the screen. I will show you everything you need to know. Trust me. You are not going to be regretting your decision. Come check it out. Let's go, let's go, let's go. All right. So I didn't make any trades today, but headband's still on. We got to go. Hey, hey, what's up? Up, down, let's go. There you go. That's how it works. All right. You got 2 targets in the FOMC. That's it. Literally two targets. Hold on, I gotta log into Thinkorswim here. Wow, thank you guys for joining the stream. We're gonna take over this time slot. There are no futures traders streaming at this time, so we're gonna take over. We're gonna build this slot up. Thanks for helping us out. Great to see you again today. Well, great to see you as always. Loading up Thinkorswim, don't go anywhere. Hold on. Hold on. And have you guys see my password. I type it in. I love My Little Ponies. 88. Don't tell anyone. Ready? I'm back. All right. Get our yellow lines together. So we got for targets today. This market is going straight up. We talked about that this morning. 54.74, the upper target here. On this line, 54.74. Wow, 50 today. Okay, cool. We've been building the afternoon stream for like 3 or 4 days now. Every day, 5 to more people. Let's go. Let's get back to the hundreds. You know, when I used to stream 2015, 2016, our concurrence would go up to like 400 or 500 people. So it tells you when you take a break from streaming, you got to really build it back up. So no more breaks this time. You guys help me build it up. We're going to stay here for good. Back in the day, it was literally just futures trader. It was just me. The longest time since like 2016, there was really nobody else trading futures on YouTube. And then about 2019, 2020 started to pick up. Guys like Tracy, Matt, Patrick started streaming, and then futures just like took off. Prop trading firms took off, and then now a lot of people trading futures, which I love. It's good to see. Good to see my fellow friends over there carrying the torch. Salute. So we're back in the afternoon sessions. Let's do this. Looking forward to afternoon sessions. I know, I like it too. I have a little more energy. Trust me, in the mornings I wake up, literally just wake up, crawl into bed, sit here and like fix my part in my hair so I don't look homeless, and then yeah, and then I sit here and then I munch my breakfast and I'm like halfway asleep. I'm like, all right, let's go. Afternoon, I'm like perfect, ready to go. Okay, the FOMC, we made a prediction today. There's gonna be no change. The whole reason I can like make a prediction by that, we look at the numbers that the FOMC board members will be looking at to make this decision, and I don't believe there's gonna be any kind of change. There doesn't need to be a change right now, so I think we're good. I'll talk about that in just a second. Right now, we're gonna highlight our targets. There are 2 targets we're gonna look for today. Upside target is 54.74. Everybody write that down. Downside target, if we do collapse, is 53.37. 2 scenarios. If scenario 1 continue to push up, write down these numbers. Watch. If it hits these numbers, like on the dot, you'll hopefully agree that I maybe know a little bit of what I'm talking about, and then maybe you'll stay. So let's make a bet. If it hits either one of my numbers exactly, and there's a high volume pivot at either one of those places, then watch the stream every day for a month. You'd be like, okay, this guy is on to something. Let me check it out. And if it doesn't hit those numbers, still watch the stream for a month. Okay. Continues to push. This hits what we call an illiquidity pivot. This is out of bounds, going to highs, and we can calculate that. There's a whole technique on how to do that. Lows would be if we flush, it has to break this green line right here for 2 if we break. Here, it goes straight down to there, I promise. That's where I'll short. Other than that, We're going to watch the interaction with this pivot. Today is the pivot to watch today. It is the pivot to watch. The pivot to watch. This is on S&P futures. CPI moved us higher this morning, floating up high, out of bounds. I normally don't trade above the green lines. Make a band. I don't have a lot of lines on my chart right here, but this makes a band called the DD band. This guy right here. I don't normally trade outside of the band. If we move too far, too fast, I don't do anything. So this morning's stream, notice how I didn't go in and try to long or short this. The market didn't go anywhere. I know that, and that keeps me out of the trade. I went to go have fun today. Chilled out, didn't do much. Thank you for joining the stream, you guys. I love y'all. Since I'm Matt is back. Hello, hello. You guys miss me? Hey, I was sporting the bandana before Hello Kitty was doing it. But it's a good look on him. I totally understand why he does it. I'm not covered in band-aids, so. All right, let's talk about the FOMC. So first of all, these levels, this is what we're looking for as far as breakout. Now, I feel like the Fed is going to do absolutely nothing today. There's no decision, and let's talk about why. Now, it starts in 15 minutes. Jeez, come on. What's that one? They can't grab. This is annoying. There we go. All right, so the FOMC is concerned about a couple of things. Inflation is the main one, and CPI today is the big reveal on inflation. So we're going to open up. If you go to investing.com, if you guys want to learn something, go to this link right here. Great place to put it. Open up your calendar. I set it to look at just USD stuff. And don't forget, your first time here, subscribe to the stream. We'd love that. You go down to the bottom of the stream, hit subscribe. We're here every day, every morning, and every afternoon. We do live trading challenges. We do everything from prop firm challenges to real trading challenges. I'm in the Robbins Cup right now. World Championships of Future Trading. Hit that leaderboard 2 weeks in. Top 5 in the world. At that point, I got bumped, but yeah, still competing. Kind of. CPI, let's open them up. There's the month over month, there's the year over year, and let's look at the core. Different kinds of inflation between like commodities and non-commodities. Commodities are things people need that are standardized. Food and energy is a big like commodities portion of inflation. The core excludes food and energy, so it looks at things that aren't necessarily like required by humans to live. Food and energy, we need it whether we're broke or not broke, right? Other things like iPhones, computers, whatever, core excludes that. Gives you an insight of what's going on. So the month over month just shows the change from one month to the next, and the change is pretty much almost always positive in most scenarios, except if you have a big nasty, environment where basically all the businesses are shut down, market crashes, big recessions, it'll go negative. The month over month change, inflation always happens because population growth goes up. There's always more people, more demand, more production, and prices just always go up. This month over month change that is like this is the same reason that your parents bought a loaf of bread for 50 cents and you buy it for $3. So every single month, inflation just goes up a little bit, and that's normal. So this number really doesn't tell you too much. You just really care that it's not negative. As long as it's positive, that's a healthy economy. A healthy economy just creates inflation. Okay, so the problem is the Fed wants to look at the total inflation to be closer to 2% per year. So the year over year is helpful at kind of estimating what that is. Now this is just the CPI. There's other marks of inflation, but you can see we're riding at about 3% year over year. The Fed has a 2% target, and as you see, we're still way above that, and inflation's not coming down just yet. Fed will raise rates to lower inflation. Easy as that. They're not their target, so they're not going to cut rates because that'll stimulate everything and inflation will start to tick up. So while inflation has been coming down normally as wages have been coming down and cost of stuff has been coming down, the Fed hasn't really hit their target yet. So it's really not safe enough for them to start trying to cut rates, especially with the market at all-time highs on its own, growing without any intervention. The Fed would rather not do anything. So because of this, because we're not at the 2% target or less, the Fed's not going to do anything today. Every single time FOMC comes up, we make this kind of call and prediction off of the data. Yeah, it creates reasonable inflation. Dot plot is on watch. Where you place the cup right now, Matt, they don't tell you anything past the top 5. And I was competing against the Robbins Cup because all the influencers out there were like, I'm competing in the Robbins Cup, and they were all calling each other out to do it. And I was like, all right, I'll come in. Let's go. I was like, let's go, boys. Let's play. And I found out that other than Matt, Tradesman Matt, who's a good buddy of mine, no one else really actually entered. Everybody was just full of crap. So after a little bit, Matt got fed up with the commission structure, and so did I. But Matt was like, I'm kind of not trading the Robbins Cup anymore. Commission sucks. It's kind of a waste. And then when I found out all the other people were kind of lying about entering, and I was like, well, why am I out here paying all these commissions? I really went to win to smack around some paper trading YouTubers, but whatever. They didn't want to show up, so Daddy put his real money back into his real account. Can you take the music down a notch? Yeah. I'm sorry. Ugh. How about that? A healthy economy creates inflation. LOL, no, it does. Population growth. Prices go up as people compete, as more people are there to compete. Here's an example. Here's an example of inflation. I have a burger store here, and I make burgers old school with a couple of employees, right? And I have a line that goes out the door, and it's extremely popular. And I start making revenues. And so what do I do with that money is I need to expand, right? So I need to hire more people. I need to build like automation, automated system now. No longer people are paying me dollar bills, they're paying me with credit cards. I need freezers for ice cream, I need all this other stuff. So I'm gonna slightly, because I'm growing, I'm gonna reinvest that money in myself to expand so I can grow more. In the downturn of me reinvesting so I can have my revenue to pay the bills, I must raise my prices. So a healthy economy, Austin, most definitely creates the environment for business owners to raise their prices. There's no arguing what I just said. To expand, you must raise your prices as you reinvest in yourself, or else you take a revenue hit, and as a business, you can't become insolvent. Take it from me, I own a bunch of businesses. As we expand, prices go up. Rocket scooter prices have gone up since we started. We hire more people, we have more bills, we need to raise prices, right? Okay, so the healthier the economy, the natural rise in prices. Any rise in prices is inflation. The cost of inflation, the problem with inflation we had here post-COVID was when everybody got laid off and businesses open back up and people are scared to go back to work. So like the first person that goes back to work, there's maybe one worker and like 20 available jobs. And so the bargaining power is in the hands of the worker who can negotiate for higher wages. The higher wages creates higher prices downstream to be able to afford the person, and therefore inflation happen there. There's different types of inflation. The increase relative to income, not just income, but the income, the cost of production, the cost of services, interest rates, and other things, Austin, and the cost of borrow money are all part of the inflation equation. What the Fed is doing to hide this problem is removing goods in the basket. The Fed is removing assets because they don't need to hold them anymore. The Fed purchased a lot of these assets during the last recession and has been floating the market ever since. The Fed doesn't need to carry a market that's now riding on a technological revolution. Like right now, the Fed does not need to intervene in the market to keep inflation down. As a matter of fact, inflation on its own is going down because there's an oversaturation of workers needing jobs. And this is the next step. Wages are plunging right now, and you can see this in all the other data. And so while inflation, the cost of something can go up because a business owner can raise the prices, but cost of something can also go up if the cost to make that thing goes up. In the burger store example, if my employees need more money, he makes this, But now he demands that he wants this. He wants a raise. And I need a worker and there's no one else available. I got to pay him more, which means the cost of my burger needs to go up. Right? So the real cause of inflation at the start was this, what they call cost push inflation, which is the cost of the upstream production. Raw materials and wages go up. And the way that you can see that, if you go in here and you look at the jolts, you can make this pretty easy to make this assessment right here. And unemployment. So you can make a prediction on the Fed pretty accurately every time with this. Let's let me just open them all up here. So a healthy economy, there will be inflation. When the stock market grows, you will typically see inflation go up a little bit. Month over month is always going to be positive in a market where GDP growth is positive quarter over quarter, which Austin, I was getting to the point, but GDP growth always creates small amounts of inflation because you have more people, more production, more expansion, and more reinvesting in yourself. Money becomes easier to borrow, so companies will borrow money to expand. And then as business is booming, you can easily raise prices without the threat of losing business because you will raise your prices at the rate at which people can afford to buy your products. So if nobody's lost their job and nobody's fired and everybody's working and everybody's making raises, then you will raise your prices so that you can give your own employees raises. And you won't lose any business because people can afford your price raise. So business owners will raise prices when things are good. And if the cost of something goes up, then they're gonna raise prices too. Thank you guys for tuning in. Love you. There's a whole bunch of stuff. So there's more to the equation. So this type of inflation we experience had to do with the lockdown. Very simply put, before we have FOMC, I'm just gonna quickly say it, is that you had like all these available jobs and market basically responded by crashing. Everyone got laid off. And then everyone said, all right, come back to work. But nobody really wanted to go back to work at the beginning days of COVID, except for like a couple people. And this guy was like, hey, I got 5 jobs that need me. And I made 100K. Because the risk is high and I'm the only person, I want 200K. And somebody needs to hire me. And one of the companies is desperate enough to get going. They're like, sure, we'll pay that. And as people trickled back to work, wages just went through the roof. And that was the initial cause of the inflation that we've been trying to bleed off ever since. Now, all the Fed needed to do to keep that from going back up was to prevent people from prevent the market from crashing, which would cause layoffs again and the same problem all over again. They need to preserve the labor market, which is what Jay Powell will say every single time. And so in these other data points here, you can see that this is what they were just watching. The jolts, the number of jobs that were open getting filled, jolts are going down either because jobs are becoming obsolete or becoming like canceled. Company doesn't need 3 accountants, they just close 2 of the positions, then the jolts will go down. Or if an available job gets filled, the jolts will go down. And that's basically what's happening. All the available jobs are getting filled because the continuing jobless claims is people that are filing for unemployment like month after month are not going up. As a matter of fact, since middle of last summer, the continuing jobless claims week over week have been going down. So the people that are on unemployment, there's fewer people over the last year. So because jolts are going down and less people are unemployed, people are going back to work. The reason they're going back to work is because they're desperate to get back into their job. They've been unemployed since September of 2022. This has been on the rise. And after a year or two, you got to start making money again. You're going to accept the lesser salary and you're going to go in a little more desperate. Maybe you made 100K and now you really need a job and you'll say, look, I'll take 80, just hire me, right? And that's what's caused this to come down. And because wages are coming down without any Fed intervention, the CPI has been coming down. Since that same period of time, since the middle of 2022, it's correlated with unemployment. Since the unemployment started turning down, let's go back here, sorry. Okay, go back to here. Not 2022, since 2023, since unemployment has been coming down, you haven't seen a rise in the CPI. You've seen a decline. In the middle of 2023, it's been flat. This is when unemployment started turning down. It's been flat. So now you can see that all the jobs data is good and it's just repairing itself. Things look great. So the Fed has no reason to intervene right now. All right, so here's how FOMC works, okay? 3 phases. Phase 1, the first 5 minutes after the announcement from 1 o'clock. The market will move a certain amount. For the next 15 minutes, it'll expand the range. And then at 30 minutes plus, then the big move happens, the press conference. This is where the big move happens. So the tricks are, don't trade it in the first 30 minutes. If you're in prop firm accounts, they usually don't let you trade it, period. So initial right here is just the knee jerk. This is the position shift. Positioning. And then this is basically like forward guidance, like in earnings. Forward guidance. This is this FOMC. The press conference is hinting at next FOMC. By the way, you guys subscribe to the platform. I mean, to the channel if you've been here or haven't been here before. We stream twice a day. We'd love to have you. Would I plan on a meetup at some point in the future? We should have a meetup in Texas, like Austin or something cool. What's the fastest source to see economic events and news? If you don't have Bloomberg Terminal, it's Twitter. Twitter is the fastest relay of information these days. I would say algorithms are posting to Twitter very quickly, unless you have an institutional level data feed or a radio tower or a Comcast tower on top of your house, then Twitter is gonna be super quick. Is it Karate Kid headband? Oh yeah. Oh Sam, you saw my bored to death slow quick city building game. Which, by the way, anything I do, I'm like excel at. I even play like a ton. I play a ton of games when I get a chance, but I have like little browser window games I play sometimes. So when yeah, I'm even world ranked in that. As goofy and embarrassing as that is. Time wasters. Yeah, I'm in my team is like second in the world. There we go. Here's the news. We're moving. Something happened. All right, here we dropping. This is the pivot to watch. Remember, the pivot to watch is this green line right here. The pivot to watch. No kidding. Second place in the world. Pivot to watch. At least you didn't see some of my naughty websites. The kind of freaky stuff I'm into. Pivot to watch is here. All right. I can only assume that the reaction, let's see. All right, so we're moving. So really, don't do anything in the first 5 minutes, I promise. You'll be happy that you didn't. Let the knee jerk happen. Let the market just move around. Right now I'm playing a lot of Hades too, if you guys like playing Hades. Great game, by the way. I did some Hades speedrunning in my day. So let's wait for the press conference. And look. So Financial Juice is a really great. Here's a website for you guys to get really good, like up-to-date news. Go here. So no change. Look at this. We nailed it. No change. So whenever you know, like I said, the Fed isn't going to change anything. They didn't change anything. That's easy to see. Now let's look at some of the guidance going forward. Two things. Number one is when price moves, let's see if you guys remember from the teaching we give you. When price starts at a certain place, right, and then comes back to the same place, what do we call it? You remember? Thank you, Tom. No change. A non-event. Non-event. And a non-event typically happens when it's already priced in. So Wall Street bet correctly. It's already been priced in. So non-event. Yeah. So there's no event anymore. So for now, there's no reason to do anything until the press conference. It's already kind of neutralized what it wanted to do. So in 30 minutes, press conference, next FOMC. So we price in exactly what we wanted to price in and nothing more. So now we wait, right? Might be saying, do I short or long this? I'll promise you something. Don't trade at all in the first 30 minutes post FOMC. You'll be happy that you didn't. Okay, so my pivots today, remember, I've got two targets today. It's here and it's here. A break of here. Break. Here. Will go here. Support here. We'll go here. In a couple of days, maybe today. 54.16 is the pivot today to watch. A break. Typically, what I consider a break in a non-volatile environment is very confirmed on the S&P when you've moved 10 points beyond it. So the confirmed break. But normally, while live trading, what you're going to want to look for, and friends, feel free to tap that like button down below if you don't mind. Man, this time slot was empty. We went from, this is like the 4th afternoon stream. We went from like 15 viewers to 30. Yesterday we had about 40. Now we have like 90, like 100. Jeez. Love you guys. Thank you. All right. A break is basically like whenever you're interacting with something, that volume is going to spike. Oh, what the hell? There goes my memory on my computer. Hang tight. Let me refresh. Hold on. A lot of data to chew on since this FOMC release came out. Don't go anywhere. Hold on. Oi. I have like a bajillion things open on this computer. Okay. Oops. Okay, right here. Okay. Normally, what you expect when you hit a high volume pivot, you're going to see volume start to spike up. And once volume starts to decay, whatever side you're on, while volume is decayed back to like its original place, like if volume spikes up right here, then I consider it now broken, usually as well. So wait for the volume to spike and decay, and that gives you a hint. I put my stops usually on the S&P 10 points on either side. Now, even if you hit the pivot, I don't enter the first 30 pretty much ever. Because the press conference is really what creates the momentum. I'll be honest with you. I would love to long right down here to be bullish forever. I made a call a long time ago that we would be bullish and hit 6,000 by this year. 3 years ago, I said this year we'd be at S&P 6,000. And I revised my tweet today and said we'll get there by the end of Q3. We're going straight to 6,000, no stops. If we fall today to this 53.37, I'm going to be jumping in long on all the things. This is my entry point for the bigger bull market. The market, this is the starting point of the rally, this 5,300 level, in my opinion. Need to download more RAM. I know I need to get the internets working. I got to go outside and connect the bunny ears to my modem so I can download some more of the RAMs. Is 5337 a yellow line? It's the dynamic hedge pressure, but it's also the DD band, right? So lower DD band this is my targets today, right? Typically when you go through upper DD band and you break through back in, very often it goes all the way back down DD band. So I'm not going to try to fade this or anything. Let's chew on that Fed data really quick. Is it in the wrong place since the reset? Hold on, let me double check. $53.51. Oh, my bad. Yeah, it's 53.51 right here. Sorry. Good call. Same spot. Sorry. There you go. Sorry, my bad. I thought that was the rarest case. Is that also break below the lower band? Right. So these days, if they do flush, they flush hard. The reason I say that is because today we're on the edge of triple B on VIX. And we all know that this level can stimulate massive amounts of volatility. So everybody write down this level today, VIX futures. 1267, this calculation is going to save your ass. Okay. If you start selling and this ends up here, it's going to run away. We know that this is a pivot in the VIX itself. It's going to cause a volatility event. We're right on the edge of all things. Today's the day to not want to be on the edge. We're on the edge. So if you break here, volatility will take over. It's very, 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 very scary. So don't let that happen. Market, hang in there. But if it does, it's great. I get a nice long entry for tomorrow. Like a one-day flush, and then the market resets and keeps going. But in the next 6 months, we're going up. The monthly maps on the S&P show you that. This is a tool that we created, the Rock Scooter platform, and you're welcome to check it out. There's an extended trial for all these indicators. It's only 35 bucks for the platform, indicators, all of that for a month. Check it out, and we'll teach you and train you in all this stuff. We created this platform. If it's your first time here, I'm the CEO of the company that made this trading platform, by the way. And thank you for supporting the company. Okay. We talked about this one this morning, but I'll revisit it today. So right here, you see these dark gray boxes. This is projecting out in time. This is the daily chart on the SPY. This is going out in time all the way through the middle of July. And you see that they're kind of like sloping down, like the bottom of these gray boxes is sloping down, just like it shows right here. Bulls are longing more over time. This is the options risk landscape, dealer options. And so bulls are becoming more bullish between now and July. The top of the bear side also sloping down, so bears are exiting position. Short squeeze is going to be imminent. Longs are accumulating, buying every dip. So it's a twofold rally. Things are so strong leading into the next month. So at least for the next 6 weeks, there is no sign we're not going to keep rallying. I use this to make all my calls on the direction of the market. I'm so excited. How y'all doing today? Did y'all have fun today? You guys trade it? Did y'all watch it? Support here goes here. If we break here, it goes really hard. Did I do anything today? So non-event. Let's chew on that Fed data. Let me teach you guys something else if you haven't learned how to do this. So the FOMC participants assessment is one of the bigger things to look for, the policy rate anticipations of the different members of the FOMC. The midpoint target range or target levels for the federal funds rate over time, right? So essentially every member casts their vote on where they think the median federal funds rate will be. So this is where we are right now, 5 and some change, right? 550 is the peak rate. So as the years go by, 2024, 2025, 2026, and longer, the votes are in that for the most part, the bulk of the FOMC believes that a lower interest rate is the appropriate policy over the next 3 years. So between now and 3 years from now, you can anticipate that the majority of Fed folks will be voting to lower the rate, which is good. Nobody, takeaways from this, nobody believes that in 2024 or 2025 or anytime, so this is this year, that nobody believes that raising rates is a policy that they want to vote on and enact. So 0 participating members believe that we go higher than 5.5, which is where we are now. So to take a bet over the next couple of years, you can almost bet that we will experience 0 rate hikes until something changes. Pretty cool, right? So each of these are like a different member, and that's what they're kind of looking at. Now it looks like a couple of lone wolves are less aggressive than the rest that believe we should lower rates at a much slower pace. It's probably the same person up here and here. The majority of them believe that 1 point a year is pretty much appropriate. The majority, I'm looking at like where this peaks right here. That's a 5, that's a 4, that's a 3, and this is about 3.5 in the middle. 2.5. So what most people believe is that it's about appropriate to go roughly 1 point a year. So starting this year, towards the end of the year is likely to lower to 5. It's roughly, since we're in the middle of the year, 25 basis points a quarter is pretty much what we're estimating. So essentially once a quarter, they're going to lower or drop a quarter of a point to equal that 1 a year. That's the forecast, right? So this is the kind of like the guidance for the future, what the Fed members are going to vote on. Does everyone understand how to read that? Does that make sense? Takeaway, nobody wants to raise rates. The majority of everybody want to lower rates. The majority of people and the average want to lower rates about 1 point a year, which is about a quarter of a point a quarter. So Fed policy believes that interest rate hikes would not be the most appropriate action, as inflation is mostly controlling itself right now, which is good. And there's really no anticipation of raising rates, which also a testament that the FOMC believes that the CPI is going to be flat to down. Because if the CPI was anticipated to go up, then some members would be anticipating that and they'd want to vote higher. So even this is predicting the next CPIs going forward. They believe over the next year plus, the CPI is going to be coming down, which is good through other means. They don't need to work so hard to curb inflation. Is a testament that inflation is going to kind of heal itself. It's good. Now we're going to go through and read some of the things. I haven't even read this yet. Does it not expect it to be appropriate to reduce policy rate until greater gaining confidence inflation is moving sustainably towards 2%? That's the first thing I told you guys who came to the stream, right? They want to hit that 2%, so they're not going to reduce the rate until that happens, which is why most people are floating here at 5 and 5.5, right? Fed officials' median view of the funds rate in the longer run, 2.8%. The longer run, that is here, 2.8%. The median view of the funds rate at the end of 2024, about 5.1%, and the previous anticipation was 4.6. So like last time around, they were being more aggressive, thinking that, well, inflation's going to come down and therefore we can start cutting rates. But inflation's been flat, right? CPI has been flat. So the Fed is like, well, probably not going to cut rates until it starts coming down. It's not coming down yet. It's flat. So they backed off on their aggressiveness, and now they're less likely to cut rates sooner rather than later. That's what that's telling you here. We all on the same page? Do you think a different president after elections would affect this outlook? I think so, yeah. I think the market right now is pricing in a Republican victory. And the stock market is very much betting anti-Biden right now. Republican victories tend to be extremely bullish going into the summer in Q3. So the stock market's leaning Republican. Like I said, I'm not taking a side for you guys or playing politics here, but market's rallying like Trump's already in office, basically. People remembering the 2016 rally, right? It was extremely powerful. Now again, it has nothing to do with the president, but sentiment is strong. The vote in favor of the policy was unanimous, so most of the Fed members right now are saying the same thing because CPI is not moving. They're not going to budge either. The Fed projections show 4 of the 19 officials saw no rate cut in 2024. 7 saw 1, 8 saw 2 cuts. So of the total officials, right? Teaching you how to read this. 19. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. Here they all are. Here's the 19 and how they're thinking. Here's the 19, here's the 19, here's the 19. You see how to read this? Cool. Okay. Fed policymakers see the 24 PCE inflation at 2.6 versus 2.4 in the March projection. The core is seen at 2.8 versus 2.6. So they see that inflation's, it's moderately expected to go higher. And in 2025, they're expecting it to be lower. And so this is why in 2025, because they're expecting to be lower, many of them believe that it's time to start cutting rates, which is when it does go lower. So most people don't think it's going lower, that it's actually going up this year, which is why nobody's budging for this year. So we can almost bet on no rate hikes, period, and no rate cuts this year either until maybe the end of the year, but starts to curve down. Most people believe next year is when we're gonna start taking action. So this is how you read all this. Cool, right? Press conference starts in 30 minutes. We'll watch that here. If you learned something, subscribe to the stream below. We'd love to have you. Check us out. We do a live show every day. Rocket Scooter's starting like a TV show kind of thing, like an all-day news channel. Pretty soon, when Marketplace launches, we'll have all kind of speakers, all kind of traders. Rocket Scooter Marketplace is going to be the biggest financial marketplace in the world when we're all said and done, hopefully. Anybody that has a Discord community, anybody that has a trading indicator, a trading product, app, whatever, we have the ability for us to automate licenses, and you can run your business through our marketplace, and we can get you featured and list you there. It's a really cool thing that we're releasing. Should be ready for all of you guys to view by tomorrow, as we're rolling all of our current existing members over there. The brand new website. Be able to go in here and search for like trade room. I don't know, just trading. Live trading. And then like a bunch of people that are here listing products, do different things. You can go through and click on something. And this person has like a live Discord. You can buy their Discord here. This is ours. You see all our affiliate relationships and our products here. You can buy our platform, our data feeds, all our indicators. You can buy it all from one spot. So basically like the Amazon of trading. We've already made a platform. So to go with the platform, we're going to let people make stuff inside the sandbox. I'm excited to share that. And that's why Matt said, don't trade and wait. Yep. Don't trade and wait. Don't do anything. Where to get the 54.74 target? Oh. I'll give you a quickie lesson on how to do illiquidity pivots. You guys ready to have your minds blown? Okay. Let me make this bigger. All right. Would you believe that in the past, let me go all the way back to the past, right? This is back in like 2021. Sorry, 2024. All right, so markets have been rallying to all-time highs, and therefore it's keep going. Okay. Would you believe that from a period in time in the past that you can actually forecast as a trick is a number that we give you. The S&P, this is the magic number if you want to write this down. Whatever, let's subtract this too. Let me do some quickie math. So write this number down for S&P, and I'll give you the Nasdaq one as well. All right. The S&P, it's 245 and a half. Actually, it was. Hold on. That's the old one. We got the new one. Okay, so write this number down. It's 240, yeah, 245 and a half. Magic number for S&P. For Nasdaq, it's here. These are illiquidity pivots. You're now exploiting market makers, dude. So let me show you how it works. This is a thing called the margin buffer limit. Oh, do I have it on here? This is like next level stuff. Take my word for it. Just watch what it does, and then you'll learn kind of like how to play it. $964.25. Okay. These are the rules. Okay. So would you believe that at a point in the past, if I were to, well, we recognize something called an event. We teach you how the event thing works, and I'll show you today's event. When we create an anchor point that creates an event, there's a whole video on it. You extrapolate that exact distance I just wrote in chat, and you draw a yellow line. That's it. That's your next upward target, projecting to all-time highs. And when you approach that yellow line, it is a major pivot. It is like the next target up. So you can see how like this exact target forecast a week in advance is the pivot. This is all-time highs at this point. This is picking a pivot. There's no support or resistance there. We forecast something that's happening against market makers who are shorting in this rally to carry all the buyers' trades. You see these wicks on this yellow line? That's the strength there. I'll show you. I'll even zoom in later, and you can see that like as we're approaching higher, that's that level there. The next step, we rally through on some kind of event. Looks like another CPI or something. Pop right here. Goes right to that level and resists. And there's your next pivot. These things are like dynamite good. This technique that we teach, learn it, study it. Once you see it, you can't unsee it. Here's this one. Boom, 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 boom. Projected from this day. Here's this one projected from this day. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 days later. That is the pivot. This is one of the first things I exploited when I was reverse engineering the CME Group's span program. This is where I get these numbers from. It's a reverse engineer of CME. Look at this. Can't unsee that. So the idea is that I'm forecasting a higher target. Look today, this day. Pop right on the tick and then turned around. These yellow lines are some of the most important pivots in illiquid markets that just rally. And I save all the history of them. Look at this one. Boom, 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 bam. And here it is. Look at these pivots off of it. They're so freaking sharp. Here. Here. Here by a point or two. Here, here, here. Pivot, 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 pivot. This particular day, bounce off of it to the tick to rally higher. Does everyone see how strong they are? Okay. This is just the next batch of them. Now this is cool, so let me zoom in and show you. Now we teach this trick in our Discord, and like I said, go to the description below. If you sign up for the extended trial, watch all these videos. These videos alone will completely change your mind about what you thought you knew about trading. Look at this day. This day, we calculated the event from right here. We anchor the point exactly there. We draw the line right here. Let me put my glasses here. I can see this. This is like, I'm sensei with glasses. Press conference starts in 4 minutes, so get ready. 53:17. Look at this. When you touch it, there's predictable high volume. We always talk about all of our indicators are predictable high volume. Look at this. Volume spiking the moment we rally up to it. And then it hovers and it decides to break. They're your next, it's like today, like longing this day would have been that target, right? Okay. The very next day, we fell right back to it. It's like glue for the trade, and then it's an amplification point when the market moves. So this is like your other day pivoting around it. And so what's neat about it is that you're forecasting into all-time highs. You're not like playing support or resistance game. Look at this day right here. Support, 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 resistance there. Look at these two. Look how cool this was. And look at bounce right there. Like ping pong between the two of them. Once you see it, you can't unsee it. And it's a very cool trick that I want to invite everybody to learn. We teach it in our courses. Look how solid these pivots are. And they stay there forever until those anchor point red lines go away. And I leave a history of all of them on the chart. Look at how cool this is right here. So we have some of them in the vicinity today, which is going to make it very important to understand like where we're going, right? So firstly, let me delete some of these because I think we already broke 5350. I need to clean this up a little bit. Yep. Okay. So these are gone. This is gone. This is gone. So anytime that you break through these lines here, we're going to delete them. So once you touch them one time, these red lines, the yellow ones go away. You're kind of like exploiting these market maker imbalances. It's kind of a really cool trick. So these are no longer in effect going forward. Delete those. Clean up a little bit. Perfect. Yeah, it's numbers like how many points it's supposed to move. So like an example is I'll show you how to draw one real quick. So you grab one of these boxes. Do it over here. We have some more going forward. So let's go ahead and make some, right? So actually let's redo it. That box. Okay. Everyone here knows how to do the technique. If you don't, it's okay. That's an easy one. Okay. Usually on a tick chart, but it's okay. Okay, so what I'm gonna do is at the very top over here is I'm gonna take one of these and I'm gonna draw it and we're gonna see how close we are. So you're not looking into the future yet. Cheat. Come on, yellow line. Bad. Oh, let me zoom out. That's my. Okay, so this one we just did is here. These are the ones recently in the vicinity, right? This is the pivoting there. So let me show how this one works. Pivot, 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 pivot. Blasting through this one. So with some upward targets there. Just kind of eyeballing where the next couple would be. There's probably one. There's probably one. Today there's going to be one. Okay. I'm going to zoom in and double check. So I'll show you how to do the technique for today. These other ones I'm just estimating. I'm doing it very quickly for the stream. I'll give her something in particular. Video will tell you how to do it, so don't try to figure it out now. Make sure I mark them. There's not one there. Yeah, trust me, this trick is awesome. We're gonna forecast some highs. Press conference starting a little bit. Oh, starting now.
And to continue to reduce our securities holdings. We are maintaining our restrictive stance of
Don't
monetary
forget to subscribe
policy
to the stream, you
in order
guys.
to keep demand in line with supply
Thank you for
and
supporting
reduce
us, by the way.
inflationary
This afternoon
pressures.
slot is our
I'll have more to
new
say about
baby.
monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter.
He's going to talk about GDP growth. He's going to talk about jobs
Private
numbers. He's going
domestic
to talk
final
about
purchases, which
labor market.
excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years.
Interesting.
In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%.
We talked about that.
Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue.
And so we talked
The
about
median
here.
unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased
Pre-pandemic
notably
levels.
over the past 2 years, but remains above our longer-run goal of 2%. Total
There's
PCE
your targets,
prices
you guys.
rose
You wanna write these down?
2.7% over the 12 months
All
ending
right, for
in
S&P.
April, excluding the volatile food and energy
Targets.
categories. Core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3%
So these are the next ones,
over the
right?
12 months ending in May.
So that's
And the
how you
core
do the
CPI
technique.
rose 3.4%.
5474 actually
The
is
inflation data
revised to
received
50.
earlier this year were higher than expected,
Or
though more
69.
recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and
Are they still the
transportation.
same? Yeah, they're still the same.
Our monetary policy actions are guided
We're gonna get
by our
that
dual mandate to promote maximum
widget in the
employment
platform
and
fix. So
stable
these yellow
prices
line
for the
numbers
American
are going to be
people.
printed here in
In
this
support
this
of
little
these goals,
table.
the committee decided at today's
once we
meeting
get the
to
bot
maintain the
back up and
target
running.
range for the federal funds rate
But until
at
then,
5.25% to
those are the numbers
5.5%,
for now.
and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year,
So listen to
the
what he's
risks
saying.
to achieving our employment and inflation goals have moved toward better balance.
Easy back on.
The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%.
See, we already talked about that
So
today
far
too,
this
right?
year,
So it's neat
the
to
data
like
have not
learn how
given
to
us
do this.
that
Like,
greater
if you want to
confidence.
save this stream and come back
The
and
most
watch it
recent
later,
inflation readings have been
can
more
almost forecast
favorable
everything
than
he's gonna
earlier in the
say, 'cause
year,
he's talking
however,
about the same
and
talking
there has
points.
been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation.
True.
At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
GDP growth is not expected, and PCE is not expected to meet these targets. So they're kind of like,
the committee will carefully assess incoming
they're
data,
very worried. They're not going to raise
evolving
rates at all because they're worried
and
about
the balance
that.
of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal
Smells like a
funds
dump.
rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year.
I think we flushed today and then rallied tomorrow. I don't think that there's going to be a lot of bull momentum off anything he's going to say today.
But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and
We already
price
guessed what they're going to do,
stability
right?
goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate.
Isn't it neat that you can predict everything he's going to... I'm going to finish all his sentences going forward.
Unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond.
That rates.
Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks.
He hasn't said certain words yet. Yeah, he hasn't triggered the algos yet.
Maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations.
Well, welcome to the 1 o'clock time slot, you guys. We love y'all. If y'all want to tune in every single day at this time, like we do, I do my live trading in the mornings. Sometimes I'll trade in the afternoons too.
Our success in delivering on these goals matters
But this like 2 p.m. time slot is education. You guys can come for free education. We love to
families and businesses across the country.
love to teach.
Everything we do is in service to
Like I
our
said, if it's your first time here, feel free to subscribe to the stream, help support us. Give a little like at the bottom of the stream, leave a comment or anything. You can check out the trading platform, get live data feeds.
Thank you, Mr. Chairman.
Get all these indicators on the platform, all the education. I'm the CEO of the company that made Rocket Scooter, by the way. I'm also streaming.
Forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really.
Which we talked about.
We're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window.
There's the... it's weird how this year-over-year reading works. That's what he's talking about.
Assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month, reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome.
It's like this year-over-year takes like data point A and then subtracts data point B a year in the past. So what he's saying is like as the year goes by, the head end or the tail end of that starts to fall off, and then you enter a different regime. So the difference, this whole year-over-year kind of thing, can have effects on the actual reported number
on a sustainable basis. And that's the test.
There's a drastic change in the month-over-month a year ago.
I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly.
I'm just going with one contract right now. The mid-swing taking quick scalps. Scared what will happen when this is over.
If we get good, better.
I will short if we break 54.16. I'll short and let it fall. I know that's 20 points away, but believe me when I say it's worth waiting for if it happens. From here, It's the risk is too bad to take a short for here for me. 54.38 to 54.69 is 30 points higher, and the greater market is still bullish. So I'd hate to be short and get squeezed to 69.
Evenly split between the two.
69.
And so I wonder,
but I'd like to be short on a confirmed break, because that's a decent ride of like 60 points, 70 points.
2 or 3 more inflation readings like the one that we saw this morning.
I'm just listening to what they're saying.
Make a September interest rate cut possible.
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summer economic projections and the dot. Is
there any way to make finance fun? Do we make finance fun here?
What I hear
finance is like finance and trading.
People are looking at a range of plausible outcomes, and in many cases they're thinking, I don't really, I can't really distinguish between two of these. They're so close for me. These are very
just when I say, like, you go to school, economics classes, they don't teach you.
And I think
they don't teach you this. We learn this on the streets.
15 of the 19 are
street economics
clustered around
Let's
one or
learn
two.
this through trading. Jay basically told you what you need to know, because he regurgitates all that information. So that's how I know all the stuff that I teach you guys. Nobody taught me how to do it. I just listen to what he says, and he's telling me what's important to him. So then I just started studying numbers he studied and started making some relationships.
A really strong
commitment
to a particular way.
What up, JD?
It's actually just their forecast.
Gonna make understanding the market clearer.
It's a combination of their forecast
be fun to everyone.
Their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for,
all right, let's check out the new.
Don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many, because really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that, and we see today's report as progress and as building confidence. But we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data.
So another thing that we're going to do, the rocket scooter next year, is we're going to start our own trading championships, right?
First day or second.
Because a lot of people talk about the Robbins Cup a lot. Robbins Cup is expensive, crazy API fees, crazy brokerage fees, and all that. But we've already talked to a bunch of influencers and a bunch of brokers and things to shop around. If you have a broker that's interested, we're going to support the actual better world championships
the data that we got today to the extent
of trading. We're going to make it. We're going to do it through our platform.
I think
there's gonna be no more shenanigans, no
tomorrow we'll know more about
multi-account entries, none of that.
But the initial CPI reading and its kind of first level translation to.
So Rocket Scooter is going to be the facilitator of the new championships of trading.
Were able to consider whether they should make changes.
Starting January of 2025, I'm making the announcement now. We will be running a futures trading championship with prizes. Yeah, no shenanigans, right? I'll be competing too, so you come here and whip my ass if you guys want to prove yourselves.
As you noted, the labor market is
I'll be
now
there.
in many ways back to where
only
it
allowed
was
to have one
before the
account.
pandemic.
I'll allow it to be audited. I won't play the leaderboard game. I'll show the results
do you think that
of
still
one
needs to be
account
more cooling in the labor market to
per
bring
person.
inflation all the way down to 2%, or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
I see a prop firm win.
Sure. So.
I'll tell you by the end of
by so many measures
this week or two, we have some irons in the fire right now,
and we've seen it gradually move back into much better
with a big prop firm company
So what
to
have we
do
seen?
something together.
We've seen
I'm just hinting at
labor
that.
force supply
A big
come up
one.
quite a bit through immigration.
And I'm not
through
talking about me
recovery
being an
participation.
affiliate and influencer. I'm talking
That's
about a
ongoing,
technology thing.
Mostly now through the immigration channel.
We'll
but
see if-
still,
we'll see if anything
we've had
happens
some
of it.
increases in prime age labor force. In terms of on the
Let's
demand
just say
side,
if that takes
we've
off,
seen,
it's a whole new thing.
We've seen
from what we
quits
built.
moving down. We've seen
Can't
job
tell you who.
openings moving down. We've seen
That's a big one.
wage increases moving from very, very high levels.
Again, I'm not
couple
talking
of
about
years
me
ago
being a
back down to more
streamer,
sustainable levels. We have seen
influencer,
unemployment creep
repping
up,
a product.
now 0.6.
I'm talking about me and another company building something.
So you
Maybe.
put all
So
that
keep your fingers
together, what
crossed
you
on
have
that.
is still
You guys
low
would love
unemployment,
it
Still 4%
if it went
unemployment,
through.
historically low.
Everyone would love it.
But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more
Can't
than
say
that,
who.
you've got strong job creation. You have payroll
There's
jobs
talks.
still coming in strong.
There's talks been
even
going
though,
on for the last-
There's an argument that they may be a bit
last month.
overstated, but still, they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the
Let's
labor
just
market very
say
carefully.
the
and that's what
outcome
we
is
see. We see
not
gradual
just
cooling,
prop
gradual
firm.
moving toward better balance. We're monitoring
Prop
it
firm
carefully
plus.
for signs of something more than that, but we really don't
Thanks
see
for all the
that.
interview. That's
As
good.
a quick
That's
follow-up,
good.
the
That's good.
surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and,
All right,
and
so let me
how
check the
does it
sandbox
change your view on
changes.
the
Looks
labor
like
market?
they.
So sometimes you can't reconcile the
Maybe came
differences.
through
You just
and
have to,
modified.
have
This
to
is
look
just
at
our
it and,
test.
and try to understand, and that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household
All right, so
survey.
here's the
job
final.
gains,
What do you
big
guys
job
think?
gains in
This is the final pricing
establishment
change.
survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way
hold on.
down, are
Housekeepers
still,
are here.
greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic.
Be right back in a second.
Overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on
Do you
what
guys like the
changed in
new
attitudes on
site, the
committee,
new
over
pricing?
the last 3 months to see
Does it look
a
clean?
shallower path of rate cuts this year?
Yeah, the big thing that changed
Data,
was the
see
inflation
options.
forecast.
There's your data.
So
Okay,
the
cool,
inflation
cool.
forecast moved up several tenths for the end of the year.
I love it. Oh.
And as I mentioned earlier in the, what did we take away from this? We had really
like it.
good inflation data in the second half of last year, then kind of a pause in progress in the first
Platform
quarter.
is
And
gonna be
what we took away
$15
from
a
that
month.
was that it's probably going to take longer
The indicators-
to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might take place
the Pro Plus will come
might have
with.
taken place this year, take
So
place
basic
next
is
year.
the free. So the platform's gonna be free going forward.
There are fewer rate cuts in the median
You
this
get
year, but there's one
delayed
more
data
next
free. You
year.
can upgrade the
So
free
you really-
platform
if
with
you look
data.
at year-end
Premium platform unlocks a whole lot of other
2025,
features like
you're
live
almost
trading,
exactly where you would have
scanner,
been
watch
just
list
a
alerts,
few
all these
months
other
later
things that we're
because
gonna
of that
make.
progress. Now,
Premium
you know that you get
platform,
different
and then the
data today,
Pro
so
Plus is like
we'll
the
have to see
premium
where
plus all the
data light
indicators that
way.
go with it.
You
Yeah,
know,
it's clean. I love it.
We're the economy has
These dudes nailed it.
repeatedly surprised
I love my
forecasters in
dad's
both
team, my
directions.
designers.
Today was certainly a better inflation report than almost anybody expected.
Can you lower music?
And we'll just have to see
yeah.
what the
I can't hear what you
incoming
guys
data
hear,
flow
so-
brings and how that affects the outlook and the balance of risks.
Gina.
Non-event today. Nothing's really
Gina
going
Smiley,
on.
New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this.
We're just listening for clues, right?
You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today, we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, though, people have been gradually writing it up.
So we have a Discord bot, by the way. If anybody has a Discord channel, we have a bot that automates rolls. There are certain like marketplaces out there that like sell that and charge like a 3 or 5% fee. We're giving that away, by the way. So like that entire
and discussion to have now, but ultimately we think that things like the neutral rate are driven by longer run, slow-moving forces.
Our marketplace for now is not taking any fees on Discord transactions, so we give away this bot for free. This entire marketplace has built their entire business off of let's charge a transaction fee for a Discord bot to manage roles if someone buys or pays Discord. We're giving it away for free in our marketplace. So we have that same service for free. And so if you have a Discord and somebody signs up and subscribes to it and you hate manually giving roles and taking roles away, I made a bot that automates all of that. You can get your bot from me for free.
Time has gone by.
We're giving it away.
How restrictive is policy has become one that everyone's asking, and we're asking it too. And, you know, my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having, you know, the effects that we would hope for.
Look at the volume spike, stoppable zone. Yeah.
Thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little
10 points away from DD. Yeah, that's the place to tap.
The combination of tipping to one cut this year.
The volume spikes right here at the top of the redistribution zone. Yeah, super easy to see that right here.
Market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet.
I would short if we broke green.
I'm reluctant to try to draw that conclusion. I think this is about, you know, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the
no man's land right here. So this is the pivot. Bulls are longing from here. Bears are shorting off of that. That's like the pivot to decide from. Everything else in here is just noise. This is just noise. Now I'm not trading any of this because I know better. Right?
How are we doing there? We think we've got a good, strong labor market still.
Yeah, DD, yellow line, they're all stacking like right on top of each other, right?
The price stability goal, and then for a while there was a pause, and we look at today's thing and we think
we appreciate you guys supporting the stream, supporting the company, by the way. Thank you for being here.
And you know, in the meantime, we're asking, is our policy stance about right? And I think we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is
listening to Powell talk.
Now this restrictive policy in place.
I'm bored.
Virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period. Unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Jobs data.
You know, it's been coming. Where's it been coming from? We'll start with that. You know, clearly, a lot of what some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is, you know, that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the
restrictive monetary policy has not been changing inflation. I hate that they're taking credit for that.
When the supply conditions unwind and return to normal. So you've had
not raising rates.
Trend.
I mean, not cutting rates. Yeah, but they
high growth, and yet you've had the benefit.
The majority of the change in inflation is coming from people going back to work.
Last year, and you will see what the rest of
the price of raw materials coming down because the shortages went away.
Can continue.
I wouldn't credit any of this to monetary policy, Powell. Stop taking credit for things you didn't do.
Are you down to demand?
Maybe not cutting rates.
We don't know that though. I mean, we're look at today's report. You know, if we
kept things in check, but
you know, we can't know.
Inflation started healing itself once you just de-bottlenecked the bottleneck. Once more people go back to work and start shipping things and transporting things and digging things up out of the ground, selling stuff, things just went back on their own.
From Bloomberg Radio and Television. The base case of the committee seems to be.
They got to see what the
that
Fed lines
there
want to
is
hear.
going
They
to be
want
at least
headlines want to hear what
one
policy
rate cut
changes
this
are.
year, but
Whatever.
your
You,
growth
me, and everyone else here knows
forecast
better. Their
doesn't
policy
see any slowdown in the
changes
rest of the year,
did
nor
not
does the unemployment
affect
forecast see
inflation
any,
that much.
Significant weakening of.
We're not in a credit bubble where they need to destimulate lending and affect the pace of that by raising interest rates. Like that happens in like
why would you
more strides in big ups in credit cycling, like not
Well, we think
post-recession from a
and we think ultimately
pandemic-related shortage of labor and materials.
At a restrictive level, eventually you will see real weakening in the economy.
RS Trading Championship,
that's always
badass. Yeah,
been
dude,
the
we'll be
thought,
like,
is that, you know, since
we need a
raised
name.
rates
So help me figure out
we've
something
always
today.
been pointing to
What is the name? Because I'm talking to a broker right now to host this through. We're going to create all the UI for it.
So
A real futures trading contest.
But so that's
one account per entry
that's what we've been getting
per person per social
progress on inflation
can be listed. Period. You can open multiple accounts for last secure and trade, but you can only as a person can only assign one account to the contest, and once you do,
support that. But
it starts tracking from that day forward,
and that's why we're watching so carefully for signs of weakness.
Can't change it after that. I'm not going to add stupid API fees on top of like Robbins Cup does. Love the Robbins Cup. Nothing against them. It doesn't attract a lot of people
We're getting a good
because
result
its commissions are ridiculous. You pay like 25 to 40% of your gains into commissions depending on trading like minis and hybrids. Like, oh, to do it. Fucking stupid. But you do it because it's like the only contest in town. But we'll be the cheap, affordable, easy one.
On housing,
we're gonna not have a 10K minimum. We're gonna lower the barrier of entry even further.
Rates are really having a significant effect. I mean, ultimately, the best.
I'm gonna have a micros competition, minis competition, or micros would basically be you can only trade micros and that's it.
There was before the pandemic. There will still be one.
That's my dream idea.
That we see now
the minis competition, you can trade anything. So people with like lower capital, like $500 or $1,000 might want to trade. They can do the micros contest. There'll be a limit to like the number of micros you can trade, things like that.
Good performance by the banks. We had
the Rocket Cup
last year, but
I like it. Come up with some names with me. I love it. But I like a really good trading contest with like actual prizes and stuff.
Plans in place. So the banking system, seems to be in good shape.
Like an example, the price could be you're gifted like 20 lifetime memberships to the platform or something, and then you can go give it out to like 20 of your friends or family or followers or whatever, and then cash prizes and things like that.
You mentioned labor markets.
So we want to have like a
inflation expectations.
Because look,
appear to be well anchored.
people use this Robbins Cup contest as marketing for themselves in the trading world. All these influencers and stuff just had fun like talking about it so they can get some headlines, and then none of them entered because none of them wanted to.
There's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel. Hi. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy? What you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably down 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction, but one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene. Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
Feelings?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy.
Are you asking about people's feelings?
People how they should think or feel about the economy. God. That's not our job. People experience what they
It's not our job to care about people's feelings.
What the data show, which is we've got.
I'm just curious, what can you do to make sure everyone feels better?
We've got a very strong labor market.
You could say some bullish shit and let the market rally. That'll make everybody feel better.
It's been a long time since we've had, a long stretch of.
I like how he said it's not my job. Subtly dismissing that.
We had a period of high inflation. Inflation has come.
I'm not here to
really
give people a hug, guys.
I'm everything we can.
J. Powell, Daddy-O.
To bring
here, keep y'all employed, give you the tough love you need,
and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people. But the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people who are at the margins of the economy who have the worst experience, who experience the most pain from inflation. So. It's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
The Fed can just start aggressively cutting rates and kick this market into a bull rally and start
cut sometime this year. And I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that
and she's acting like a quarter of a point
confident that inflation
rate cut's going to change borrowing rates for like mortgages and credit cards and stuff.
Then we can look at loosening
to some significant degree.
So,
they want to see that. They want to see the pivot down.
Inflation will be at 2%. It just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people cannot think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place.
She didn't understand that, like, she's asking about inflation and rate cuts at the same time. They don't go hand in hand. You don't, cutting rates doesn't lower inflation. Like, I don't think she understands that. I think she's talking about things that don't make sense.
Jones, Financial Times.
That's why he corrected
just
her.
drawing on the change in the statement on there being modest.
And it's hard. Inflation's hard on some people. We get it.
You know, halfway, through
The Fed is kind of doing what they need to do.
CPI release, what have you and other committee
can't do much.
members found that has been particularly encouraging to you?
I feel surprised and
and
woke
just
is
in terms
ridiculous.
Of the conservatism, how much of
Can you
that
help
is
us
about
understand? There are a lot of people that-
stickiness in shelter inflation?
What can you say to make people feel better? I know you don't have a crystal ball, but can you just give us a hint?
Been that
Best thing everyone can do.
growth, the growth
Lower your
clearly
spending.
that we had last year, particularly the second half of last year, and we continue to see still strong growth.
Work
solid
harder at
growth
your
this year.
job,
That's
produce
been very
things, and then
If you
we'll
go back a year,
eventually be out of this. It's
there
not
was a real
that
concern
bad.
about,
The inflation
very much
is
slowing
bad-ish,
growth
but
and
it's not
recession.
that bad. There has been
Forecasters
worse
had that.
times
And that's
for
not
this
what
country and
happened.
other
Instead,
countries when it comes to
the US is-
inflation.
anyway, and it's in sharp distinction with many other advanced
It's
economies
hard
around the world. So
on a lot of people,
that's
but it's
been
not.
encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about.
It could be much worse.
Your second question was really about shelter inflation. So.
What's he
I
talking
think
about now?
if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when
Minu
market-based
sent you.
rents
What's up? Welcome to the
go
stream.
up sharply as they did at the beginning of when the economy.
I've heard of that
reopened,
person.
They really went up sharply. Those play into.
She
rollover
seems kind of
rents
cool.
Much more slowly for existing tenants than they do for new tenants.
We're watching
so what
J-Pal talk. Having a snooze fest here. The market not doing anything.
So there's sort of there's a
Love this, Matt. What up,
bulge
Annie? Good to see you again.
High past increases in market rents. It has to get.
I saw
worked
you
off,
in the
and
chat
that
feed
may
yesterday
take,
in Matt's
several
stream.
years.
I popped in there for like 10 minutes to watch. I saw your name pop up.
Relatively low levels, and they still are.
That's awesome. I like watching
this is just going to happen. It just is going to happen more slowly than we thought. We
We're bringing the afternoon session live, baby.
A rental value to.
We're gonna do this every single day, 2 p.m.
Homes.
Live trading. During events, I don't normally do a lot of trading. I have my break points there where I want to trade if I do take a trade, but we haven't even touched it yet. So we're kind of just dilling in the middle, and I don't like to play that.
It's not something that we're the only country that does.
You like the afternoon streams?
We're
Oh,
looking
thank
at
you.
changing or would look at changing.
Afternoon streams is a little more fun, I
anytime
think.
soon. But it's true. It's one of the very hardest things in inflation.
So not making
and in
any
prices
trades today
is how
on
to
this.
think about, the services.
Don't
that
forget, you
someone is
guys,
getting by
subscribe to
living
the
in a
stream.
home
We're
that they
here like
could
every
rent,
day. If you give
that
us a
they're actually
sub,
living
that would
in.
be
And
awesome. We love you.
sometimes you should just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
I watch Minu streams. She's
Fox Business. Thank you for taking
pretty
the
awesome
question.
streamer.
Chair, so I want to go back to jobs and the consumer. The last jobs
I'm a
report
big
showed
fan.
that over the past year, 634,000 more people took multiple
Who here is a fan of
That's
Minu,
up
the streamer?
8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe
Don't
break
diddle in the middle.
companies
Yeah,
in terms of
don't diddle in the
hiring
middle.
or break the consumer
Look who
in
that
terms of
is.
spending?
Yeah, some of you wouldn't know because
we
y'all are
monitor
a bunch of trading
all the things you
degens.
mentioned and more.
She's a Twitch degen.
Basically, spending was
She's
going
not a trader,
up
though.
faster than disposable income during big
She could
parts
be.
of
I bet
next
you- I bet
year,
you could
so
train her
last
how to
year rather.
trade.
And so what you'd expect to see is people
Be better
spending
than
more on
I
their
am.
credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. We remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago, and we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as they're spending, or companies can't hire like they're hiring?
Consumer
That's
spending
gonna
is
happen
still
to everyone
growing.
board.
It's not growing at the pace it was
She's
growing
awesome, though,
at,
yeah.
a year or so ago, but it's still growing solidly.
Appreciate
And by
the
way,
raid,
other
you
parts of the
guys. That's
economy are
awesome.
picking up.
I do live streaming in the mornings, 9:30 when market opens. I'm usually like 10 minutes before that. I do live streaming, live trading. I'm a full-time futures trader, CEO of this trading platform company here. And I started doing afternoon sessions, so those of you get bored, y'all do any live trading or anything, feel free to come over here. We teach trading. You can watch me trade live, all kind of stuff.
No, you're right, though.
And this afternoon session, we just chill, jam, listen to music, make some trades, talk some shit, have some fun. Seen a lot of homeowners upside down in their home loans. Yeah.
Is to foster a very strong jobs economy, which we think we have.
I mean, especially a lot of homeowners that bought houses like right after COVID, right? That's what I was trying to do.
Very painfully.
And then COVID happened, like 2019, 2020, I was in the market for a new house.
Which will also improve things.
And that foiled those plans, but a lot of people went out there and jumped in on those, houses paying like twice what they were worth, and
I was just wondering,
now they're paying the price of it. Interest rates are high, they can't afford their mortgages. Not getting the massive salary they got before.
People losing jobs? Is it more the level of
Credit card debt numbers are crazy. Yeah, everyone here is like floating themselves on their credit cards. It's really tough. It's tough around the country, like in general. I mean, even Rock Scooter's business, while we've been like increasing, like we had an explosion of growth last year. Like even our growth is slowing down because of inflation. Trust me, it affects everybody. Not as many people buying,
the labor market,
trading products.
Has the ability, has the tendency sometimes to move to weaken quickly. So
renting's the best option right now. Like the option that makes the most financial sense right now is renting.
Looking at the balance of risks. I always point out the balance of risks. So
for anybody,
and also the fact that we look at all of the whole situation. So.
Let the burden of high interest rates be on the homeowner. Let the, like you said, the homeowner right here who's upside down their home loans, and as the renter, it's not your responsibility to deal with that. You just pay your rent and that's it. Now rents are high, but when you factor in the cost of owning a home, cost of repairs, cost of warranties, homeowners, HOA fees, all the stuff that comes with the home,
we look at the broader context of what's going
you're going to be super upside down in this day and age and stretch a little harder.
Yeah, I mean, I can think of things that would.
It's about 2020, probably for the next 2020 to 2025, renting is the smartest option.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year, that it wasn't 1 or 2 months, but 3 months.
Used to think that also, but rent right now is basically mortgage payment, but you have a point with the repairs. Well, yeah, mortgage payment plus repairs plus other service fees that come with like homeowners. Like if you, the trash fee, the water, the garbage, all that, the recycling, all that stuff. Some homeowners pay for that, some owners don't.
Mechanical thing,
appliances, things like that. They're adding a premium to the mortgage for sure.
It's going to be the totality.
But also, the cost to borrow money is going up. Like you have to pay ridiculous amounts of interest. While you're paying more cash out of your pocket to rent, you're not paying interest like on a home. Like if you go buy a house, it's not like you're really paying much of the principal anyways. You're just basically paying to the interest, which is just like renting.
I just don't think we're not
Hold on one second.
been able to do that.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has been has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once, you're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation?
So we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there. And
all right, I'm back. Sorry, a quickie phone call there.
Have a strong economy.
Ooh, baby. All right.
Growth. All forecasts are very commonly around 2%.
Yeah, for an investor literally paying over asking for a multifam
pretty high rate,
and it needs major repairs. I try to tell him now's not the best time to listen. Is he going to rent it out?
Approach this question carefully, and that's what we're doing.
And just to follow Chair Powell,
The cost to borrow money and build stuff and invest in things and borrow money is
otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework. And we think
so support at that green line, and we're going straight to 54.69. That's what I'm looking for. Market's not selling off. Clearly, I'm not trying to fade this.
Thank you, Chair Powell.
Anybody here try to fade this or do any kind of short at all?
You
How y'all doing
mentioned
on that?
before the framework review
shorting for me
process will
today.
start in the latter half of the year.
Rent two parts and live in one
at this
part,
point, do you
but it
have
needs
any
a
specific
roof.
time frame for the start of that?
Isn't that one half of the housing concept?
A committee group,
1/3 of the housing concept.
of your
There's a
peers?
roof. There's walls and a
What will
floor.
Be the parameters.
Missing
do
one
you
of the key
anticipate
components of a
review
house.
Will consider changes to communications going forward.
So
No chance of fading this. Good boy,
what
Chris.
What we're thinking is that we would announce and commence
Loki,
the review
nah. Riding with the longs,
later or
baby.
late in the year.
On the sidelines for now. I know, right? Sidelines is like pretty much it for today. Upside was expected, this 54.69 level. Remember, I told you, if it hits that yellow line,
Within scope,
you have to watch the stream for a month. That's the new rule.
communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't.
Zachary, the answer is yes. And we need to repair the bot as well. So the answer is go ahead and do that. It only costs $11 a month for data, for futures data.
Test, which is
go with AMP as a broker. They only require a $100 deposit
alternatively, we see
through CQG. So if you go through CQG, we have Edge Clear on there, but I don't recommend them anymore because they require a $500 deposit. Great broker, great company, nothing against them. But just for data feeds, you know, no one's locking $500 and they won't budge on that. But AMP is very generous on that. If it's just for data, AMP's the best way to go.
And overall employment. So
it's for trading, they're both good.
Housing prices remain
Those are two
sticky,
recommendations:
slow
Edge,
down
Clear, and
with the
AMP.
pace of rate cuts?
And
I think you look at the we'll be looking at the aggregate
yeah,
numbers.
when you do, this will populate with that data.
What's going on?
But the reason lately it's been broken because all of our developers haven't been able to fix it yet because we're pushing out this marketplace thing that's coming out like today. And as soon as we're done with that, we're going to come back and repair this. There's just the CME group changed their website. And so our bot that reads their website, obviously, if they change it, then the bot can't read the data correctly. So we're going to go repair the bot. But as soon as we do, Zach, yeah, correct. It'll show up for you automatically. And you can come add any futures contract you want in here, and they'll all be available for you. Yeah, AMP broker, $100 deposit, $10 a month CQG fee, $1 a month top of book CME data. Just get the top of book. Like here's top of book right here. It just shows the bid and ask. You don't really need the level 2 unless you need the level 2. I don't recommend level 2 for anybody. I love that epic sounding Fed music. The event has now ended. Has a kind of like Hollywood Oscar feel to it, like everyone's like saying they're proudly at their mission accomplished. Mission accomplished, sir. All right, this is one. Need to rewatch the videos. Boring. So boring, I know. Looks like we only do DD bands for Nasdaq and ES, which I think it was for ETFs too. Yeah, we do DD bands for every futures contract you do a DD band for. It's the closing price, closing the Globex close, plus or minus the risk interval, and it holds till the next Globex close. So it's all night session, all day session. And we do that for all the futures. Anything with a margin requirement, you can create a DD band for. The bot, I only put index futures there just because I can only run so many of them efficiently per day. I don't personally go out there and do all of them for everybody. Sure would have been nice after all. Not really. I mean, think about it. Like price right now, there's really no, like I only trade off of pivots that matter. Like I don't, you guys know me. I don't trade. I don't fuck around in the middle. See right here? Price started there before the announcement. Price is here before at the end of the announcement, like hours later. Right? Whole lot of nutting. And it's only, you're only trading in like a 20 point range right now. Like I said, nothing good happens end of the day like this. The market's pretty random and crazy. About time to call it. What do y'all think? Or do y'all want to hang till market closes? Really not much to say. Keep an eye out at this green DD band today. Got on my face, Mike. I'm so bored. At least I'm excited the housekeepers are here. My favorite day of days of the month is clean day when everything's clean. I love it. It smells so good. Keep you from falling asleep. You think I'm exciting enough to keep you from going to sleep? I'd be going to sleep. We're now bullish triple B if it holds. Yeah, we'll see. Keep an eye out for that number. Yeah, that's very important. Talked about this one today. VIX futures 1267 is a very key level. It's trying to move, so be careful. Careful, traders. Watch out. What do we do? What do we do? No trades for me today. You got short at 45. Chris, you are a madman. Good job. I said I wasn't going to do it, but I couldn't resist it, so. You're nuts. Good job, though. You want long 17 for a little scalp? Dude, it's too close to the end of the day. I don't normally trade after 2. And it's now 3:30, so I don't know. I don't touch the power hour thing. I don't. Market's just random and garbage here. Like, it's not really good trading. Like, today, I didn't make any trades today. And what's funny is that we're back to the open of the previous of the session. So what's neat about understanding that, we open here, we're back there. I didn't touch this. I didn't long, short, I didn't get squeezed, nothing. Smart enough to sit down on this one, right? And sometimes it's the best way to go. Be a little smarter about this than usual. This is that pivot. Here it is. 54.16. Some change. Let's see how right I was. Do we support here? Do we resist here? So another thing, not to tell you what to do. Had I been in a short and I hit that pivot target, I usually personally myself trim something. Hold a runner in case it collapses, because it collapses big if it does. But I normally get out of the bulk of my position just on that scalp alone all the time. If you're not going to trade, at least take a shot at tequila. Bro, I would love to take a shot at tequila. I got to run upstairs, though, to get it. But tequila would be great right about now. Can you not drink on YouTube, though? I think they have a rule against it. You know, one time I got banned from YouTube for a day. So I argued it. Because they saw my mini fridge, which is, you can't see it. It's like back over. Oh. I have like a mini fridge right here. Over there. And I had like energy drinks in it, and it had ginger beer in it for, you know, Moscow Mules. And it just had ginger beer on the can. And YouTube banned me for a day and said, you're showing alcohol on your stream. And I had to prove to them that ginger beer was a soda. And they were like, oh, okay, crisis averted, you're good. And they reinstated my channel. But yeah, I logged in one day to stream, and it was like, you've been banned for violation of our policy, blah, blah, blah. I know I've done it before. I know I've drank on stream before. I just wonder what they would say. Maybe if I don't show the tequila bottle, but I just show the drink. Tequila reminds you of Pee Wee Herman. Tequila. Yep. I have drank on stream before. I've also eaten a bag of Skittles with a spoon on stream before. Done a lot of goofy stuff on stream. One time I wore a Cobra Kai headband, and then people told me never take it off, and now I wear it all the time. I do want a shot. You know what I drink now is gin. I don't know if anybody here is a gin drinker, but last couple years, my palate's changed, and I'm totally in the gin. My favorite go-to drink, I have 2 really good go-to drinks to do right now. The non-gin one is a yuzu sour. I'm totally copying a restaurant that I go to that has it. It's really, really, really good. It's star anise simple syrup, so I make it myself. Yuzu, Cynar, really, really, really good. And some bitters. And the other one is gin and tonic, but I do a grapefruit gin and tonic, and I make it with Empress elderflower. So if you've had the Empress, which is like the blue one, they've got a red one that's elderflower and rose flavored. It's amazing. So that, and I make a grapefruit simple syrup. So basically, like, I juice the grapefruit. 1 part grapefruit juice, 1 part sugar, zest. 1 cup of grapefruit juice is like 2 grapefruits. I zest both of them in there, stew it for a little bit, and then strain out the rind. You know, my syrup. And it's 1-to-1 ratio of the elderflower gin and then that grapefruit syrup, and then the little can of tonic. Dude, it's the best. Chartreuse, yeah, dude, I love chartreuse actually. Try ginger ale. So ginger ale is just like ginger ale with gin in it. I'm down with that. I know for some reason, like when I was younger, I just never liked gin. I was always a whiskey person. I liked like the smooth kind of like molassesy taste of like a good bourbon. And then I started drinking rye, and I started like palate like favorable for like more bitter drinks, I guess. Rye is like a little hotter on the tongue. It's not so like smooth and sweet. And then I started drinking gin, and gin was just like, yeah, it's like this tastes like soap, and I hated it. And then as I started drinking it, realizing that like the best cocktails have gin in them. It's such a great flavor once you get accustomed to it. Then everything else tastes like shit. So like when I drink tequila now, I feel like I'm in college again. And I used to have a really good palate for tequila. I'd love the taste of tequila. Like when I threw that huge party for Rocket Scooter launch, I mean, we were drinking bottles of Clase Azul that night because I was just like, it's so smooth and so good. And now when I drink tequila, I'm like, yeah, it's good. I like it. But like, gin's my new sipper. Tequila is like I want to get hammered. I'll just drink tequila shots all night long. Old fashioned right there. There you go. I love old fashions. I didn't realize how that sneaks up on you. The one thing I like drinking next thing I wake up the next morning. Yeah. What's your favorite whiskey for an old fashioned? You do rye? You do bourbon? Like, what's your favorite? I have a couple of good suggestions for gin and for old fashioned. Like my go-to bourbon for an old fashioned is Rowan's Creek. It's just simple, good flavor. Bullet or Makers, yeah. Bullet, or however you say that. Good. Rye, I like Whistle Pig. That's usually what I go to for my rye. Rowan's is good. It's owned by the what's the name of it? My brain just stopped working. It's part of that big whiskey family. What's the name? Willet. Yeah, it's the Willet. It's part of the Willet family. Whistle Pig is some good stuff. Yeah, it's so good. Super good. My sipper on some rye is the 15 year. It's a good one. Like a $220 bottle maybe these days, but for sipping on, it's great. All right, I'm gonna call it. I'm out. I love you guys. Love you. Really, thanks for coming. Thanks for supporting the stream. Don't forget to subscribe on the way out. Give us some love. Thank you for supporting the platform, supporting the drive. I mean, we're building some huge things over here in trading. Platform, marketplace, code your own indicator, share your own alerts. I mean, all this stuff is coming out soon. We've been spending a lot of time, I know, focusing on the marketplace itself. Well, now that's over, pretty soon, our development hours are going to be spent back on beefing up the staff for the platform, building features. I'm excited for that to kind of return to form, get a lot of the stuff made that we want to make for the platform as our next step. So thank you guys for tuning in. We love you. Cheers. See you tomorrow. all this talk about drinks, I'm going to have 2 and wind down my day. Crap market didn't go anywhere. Blah. We'll come back tomorrow. Hopefully this bull market continues. This is great. Great trading. FOMC, good stuff. We'll be here 9:30 in the morning. Early. We're usually here a couple of minutes before the pre-market. Catch us live. I'll be trading. Live trades on stream, fully transparent. Watch everything I do. Ask some questions. You know, same old thing every day. So we love hanging out. Love y'all. See you later.